Good morning. Sorry for the delay that we run into some technical errors. So let's begin without further ado. For those who don't know me, my name is Peter Ng. I'm actually covering the property developers and hospitality sectors. Now, today we have a non-rated note on Ingley International Real Estate. It's basically based on a site visit that I've been to 3 weeks ago. So, who is Ying and what do they do? They are the real estate developer of residential office and retail properties, and its primary focus has always been Chongqing, but it's recently expanded into a tier one city. And ever since their inception, since 1993, they have completed 9 developments. So completed developments include grade offices, retail malls, residential properties, and car parks. And on a side note as well, they manages the shopping mall properties in order to extract rental income. Now, this is just a little bit on their business model. Typically, they develop when they develop residential and office units, they would sell them as a form of cash flow projects. But when it comes to mixed developments, it's a little different because they would sell off offices and residential units, but retain the retail malls portion in order to get rental income, which is more recurring in nature. So lastly, location is key for them when selecting projects. Okay, can I just bring attention to the pictures that we have over here? The developments in blue are what they have completed. So if you look at it, some of these properties, which are which has this red trace around them. These are actually the malls that they have retained. And the properties that are in orange, these are the currently developing properties that they have. This is a year-to-date price chart of Ingley versus the STI. Now, just a little bit about the macroeconomic environment in Chongqing. Chongqing's GDP growth rate has actually exceeded China as a whole. China in 2012, 2013, 2014, growth rate has been around 7-ish or flat 7%, while Chongqing has stayed above 10%. And more importantly, for urban disposable income per capita in Chongqing has registered close to 50% growth since 2010. I mean, between 2010 and 2014. While we do know that there's a decline there, but still, having a 50% growth between 2010 and 2014 is pretty high. In September 2014, state-owned enterprise China Everbright actually came on board to Yingli with a 14.9% equity stake. I know this slide is a little clunky, so let me just do a summary here. And for Yingli, they benefited in 3 ways. First thing first is they are able to leverage on China Everbright's expertise towards managing malls, and we'll see that in a while. And the second thing is that because of their state-owned links, they are able to provide Yingli with greater accessibility to funding sources. So this is actually vital because they can actually take on larger scale projects such as future Beijing, which we'll take a look later on. The third thing is that they are able to go into tier 1 and tier 2 cities by leveraging on China Everbright. These are some pictures of the rebranded malls. So I can just bring attention to some of these pictures here. If you look at the first picture, it's actually not a scaffold. I mean, it's not a construction, but it's actually what do you call that? You call it an asset enhancement initiative. Basically, such developments encourages um, more shoppers to come in. You can look at it as though like um, as attempts for them to bring in more shopper traffic. Okay, so next will be updates on development projects. There are 4 developments, and under these developments all together, there's 2.6 million gross floor area that is currently being developed. The first development is the International Hardware and Electrical Center. This is a BTO project with 3 main phases, and this has actually been a timely project for them because it actually coincided with Chongqing's government intention to decentralize more than 180 of these medium and large enterprises out of the CBD. And the strategic alliance forged between Ying and Chongqing Hardware and Electrical Industrial Association Alliance actually helps them to reach out for more buyers. And how is that so? Because under this industry association, there's actually further down it, there's 9 more other trade associations, which is formed by more than 5,000 companies. And the other thing is that pre-sales has not commenced yet, but it's already a pre-registered interest, 100% pre-registered interest for phase 1A, and that represents 26.5% of its total gross floor area. And what I mean by pre-registered interest without pre-selling, that means people has already put down deposit, a 10% deposit. For this development, GDV excluding car park is RMB 5 billion, and for the entire development, that means 1A, 1B, 2, and 3, the total GFA is 1.32 million square meters, and the expected gross margin for phase 1 is 15%. Next is Ying International Commercial Center. It's a mixed development project comprising of retail, SOHO, and office units. So it will be developed in 2 phases. Phase 1 will be completed in 2017, comprising of SOHO, retail malls, and car parks, while phase 2 will be completed by 2019 with the remaining retail and office units. And what's interesting about this development is that the project site is the largest land parcel closest to Jiefang Bay pedestrian street. And the Jiefang Bay pedestrian street is equivalent, sorry, the Jiefang Bay the area is equivalent to the Raffles Place of Singapore. While the other thing to note is that although we expect that take-up rate might be weak to moderate, we'll get into that in the next slide. So the GDV of this development is RMB 3.9 billion and GFA is 300,000 square meters. Pre-sales is expected to start in late 4Q15. This is a price history of Chongqing office properties. If you look at it, I'll just bring attention to the axis on the right. If you look at it, it's actually prices of office developments have actually continued its decline. Although in April there was actually a growth, but nonetheless it's not sustainable. As you can see that for the next few months it continued to decline. So with that in mind, right, we think that prices of office developments will continue to trend down. Okay, third development is Sanya 1 Phase 2. It's a residential development project with 4 phases. And for the sales at 2 and 2B, it has been encouraging because we see pre-sales level of 78% and 58% respectively. So we project that take-up rate will be strong. We'll get into that in the next slide. So that's on the back of favorable government policies to encourage home purchase. Because in March 2015, down payment requirements for residential units have actually fell. The requirement to put down down payment when a Chinese citizen purchase a home property in China has been reduced from 60% to 30% for first home buyers, and for anyone else, or essentially anyone else, like if you're buying a second home or third home onwards, is 30%. And the next thing to note is that it has a well-connected location. It's is located directly in front of the development project is located right. No, sorry. Let me do that again. I'll just bring attention to this picture first. So currently it's constructing a Metro Line 10 station, and that station will be directly in front of the development, right across the road that my mouse cursor is on. So, but at the same time, there's also a currently functioning Metro Line 3 station, which is on the west part of the development. It's around a 10 minutes walk or so. And also it's near to nearby lifestyle amenities like IKEA. But for this development, the GDV is RMB 1.2 billion, GFA is 275,000 square meters, yielding a gross margin. I estimated gross margin for 2A and 2B 20% onwards. So you might be thinking that why am I looking at these GDV figures? That's because um, when when we value a property company, more importantly, development properties are actually held on book value. So with GDV figures, you actually price it, you actually uh, reprice these developments into, you bring it to its market value, which is more representative of what is actually the value of it. Next, just now as I was saying that why do we think that take up rate for these projects is projected to be strong? Um, I've explained that there's lower down payment requirements. Then the next thing is that since August 2015, the Chinese government allows participation of foreign nationals to buy properties for their own use. Although the own use is not clearly defined, but um, it is as long as as long as the purpose is I would say that it covers a wide range of activities for use. Okay, this is the fourth development, Future Beijing. It's a mega-sized mixed development project, and this also marks Ying's foray into a Tier 1 city, Tongzhou, Beijing. Tongzhou is a satellite city which will house three municipal governments, Beijing, Hebei, and Tianjin. So, and at the same time, it will also be the eventual plan of the Chinese government is to house 130 million people within the satellite city. This development is located directly above an interchange station of Metro Line 6 and R1. R1 is the extension of Line 1 in Beijing. So if you look at the map here, from central Beijing to travel to future Beijing, the future Beijing development takes around takes a 20 minutes train ride. And also the location is in close proximity to other commercial developments such as Universal Studios, the upcoming Universal Studios, and certain government entities which unfortunately have not been disclosed yet. Inglee's current stake in the project is small, but we expect it to increase further. So effective stake as of now is 15.1%. As of now means 30th of June 2015. The initial investment outlay is 559 million RMB, and other investors include China Everbright, which I spoke on earlier, and Huaya Capital, which is also a state-owned enterprise. So Inglee's strategy is actually the same as what we have spoken when we're discussing on its business model. It intends to retain the retail mall and car park after the other phases of the project are sold. So the other phases includes office and Soho units. Pre-sales is expected to commence late 4Q15, and the estimated average selling price based on comparable transactions in the vicinity is RMB 32 to 35,000 per square meters. The potential catalysts for the stock, there are three of them. So we expect higher revenue recognition from pre-sale units. So um, there should there should be more recognition from 2016 onwards to 2019. I'll show you all later what I mean by this. So, and at the same time, the management is also reviewing the possibility of instating dividends. And lastly is an eventual REIT spin-off. This is not a new story because it was actually said before in 2012, but unfortunately it was unable to do so because even if you look at the portfolio size today, size is still a challenge, or that is to say that an eventual REIT spin-off is only possible when the portfolio size becomes bigger. So there are three key risks as well for Ying, two in the near term. No, sorry, three in the near term. So we talk about the sales of International Commercial Center, the development project at Tiefang Bay. Price, but due to the brick prices, we don't expect the take-up rate to be strong. And the second risk is balance sheet may take some time to recover because net debt to equity, or essentially gearing ratio, has gradually increased to 62.9% as at 1H15. This is because they have used more funding for the construction of existing development projects. And lastly, FY15 earnings is expected to be weak because at least until more revenue from the units that are sold in 2015 are completed and recognized in 2016. Okay, on the valuation side, I'll just bring attention to the price to book ratio of the other of all the Chinese developers in comparison. So for Ying at 0.47, it looks fair, but if you were to go down the line, it looks like if you look at China Yuan Bang and Chiwei Land, yes, correct, they are cheaper at 0.09 and 0.21, but at the same time, its balance sheet is also pretty much leveraged. It's very leveraged because if you look at China Yuan Bang, it's 131.9%, and Chiwei Land is 287.1%. So, but nonetheless, most Chinese developers are trading at historical low price to book ratios. If you look at Ying right now, and even in 2008, it was at 2.14, but currently is at a historical low of 0.51. Okay, this is a waterfall schedule of the development projects, sales and handover. Um, so if you look at it, in 2015, there were at least there were five developments that has conducted pre-sales, and only in 2016 will there be handover. And what I mean by handover is that you when a developer sells a property, the revenue recognition can only be done upon the unit's handover. So to look at this simply, the more green fonts over here, the more revenue recognition. So you look at it between 2016 and 2018, there'll be more recognition. Lastly, these are some other developments from other developers that we have also taken a look when we are in Chongqing. So this is Capital Land's mixed development project at Chaotianmen. The investment is $4.3 billion. It's also 4.3 billion Singapore dollars. It's also a mega development. And lastly, this is Perennial Real Estate's mixed development project at Beijing Tongzhou. So for Ying future Beijing, it's the largest development within the vicinity, followed by Perennial. Yep, we have come to the end of our webinar. So if you have any questions, feel free to ask them. Hi, sorry. We'll be waiting for questions, but the questions mainly pertain. I have two overlapping questions, which is asking about Capital Land versus Ying. I would just like to remind everyone that it's not operating on the same business model because for Capital Land, you can look at it as more like a landlord business because 71% of its total assets actually contribute to recurring income, while only 29% of it comes from trading income. So it's not a fair comparison to compare Ingli with CapitaLand on that sense. Okay, okay, if there's no other questions, we'll just end the webinar here. Thank you for tuning in. See you next week.